we'll start it like that. Oh, and then we share. Perfect. Hey, Mildred, how are you?
Good, and you?
I'm doing good, doing good. So I was thinking we can do like maybe 5 practice questions to refresh chapter 3 before we completely dig into chapter 3. What do you guys think? That work? You're both muted, so if you said anything, I didn't hear you.
Yes. Sorry, I thought I was unmuted.
Okay. So practice question. According to the entire contract provision, a policy must contain A, a copy of the original application for insurance, B, a declarations page with a summary of insureds, C, buyer's guide to life insurance, D, listing of the insurance, former insurance for incontestability provisions.
A.
A. Good. According to the entire contract provision, what document must be made part of the insurance policy? A, outline of coverage, B, copy of the original application, C, the buyer's guide, D, the agent's report.
I think it's the same question, kind of separate.
Yes. Perfect. It is the same question, just said differently. I love it when it does that because then it gives a more clear idea of what you'll see in the exam. According to the entire contract provision, a policy must contain. There you go. That's exactly as the first question that we saw. So let me move a little bit and see what we get. It's the same question.
Mm-hmm.
And this insurance clause, so you see like it's a lot because I was scrolling through chapter 3 and I'm like, oh my God, it's a lot. And then we're getting like the same questions basically. So let's just go to the terms to know. So activity of daily livings. Actually, let's go back up a little bit more. Chapter 3 is all about policy writers, provisions, options, and exclusions. So yesterday or the day before yesterday, we saw all about life insurances, the types of life insurances, term, whole life, all that stuff. Now we're inside the life insurance policy. So we're looking at their provisions, the writers, and the options and exclusions that the policies have. So provisions by definition is define the characteristics of an insurance contract and are fairly universal from one policy to the next. Writers are added to a policy to modify provisions that already exist, and options offer insurance and insureds wait to invest or distribute a sum of money available in a life policy. So to say here, provision define the characteristics of an insurance contract. So that's basically what the contract is. How much you're paying for how long and what's the benefit of it. So those will be the provisions of the contract. Riders is if you add anything to it. In my case, I have child riders, right? So if you have accidental rider, anything like that, that'll be an add-on on the policy. An option, by definition, it just offers basically how you want to see the cash. So that those type of options, we'll see them only in what type of policy. What do you guys think?
Like the
which policy gives you cash, or which type of life insurance gives you cash?
The whole value.
Yeah, the whole.
I mean, the whole
the whole life.
Perfect. That gives you so options, just so you see, offers insurance and insureds way to invest or distribute a sum of money. So you can only invest when you have the cash value. You only have cash value in all of the whole life policies. Right? So we discussed those 3. Okay, so terms to know. Activities of daily livings. It's a person's essential activities that include bathing, dressing, eating, transferring, like lo que hacen. Día a día, en la vida, what's needed, that wake up, brush your teeth, those are activities of daily living. Assignment is transfer of rights of policy ownership. So when you assign something to somebody else. So it's a transfer of ownership rights of a life insurance policy from one person to another. Consideration, something of value that each party gives to the other. So it's the binding force. That's something of value I give you. Let's see what else in here says. Yeah, so the consideration on the parts of the insured is a payment of premium and the representations made in the application. The consideration in the part of the insurer is a promise to pay in the event of a loss. So like I was gonna say, I give you payments per month, you give me a death benefit. Those are the considerations on a life insurance contract. Indemnity, a principle of reimbursement on which insurance is based in the event of a loss, an insurer reimburses the insured or beneficiaries for the loss. So una indemnización. A lump sum, a payment of the entire benefits in one sum. Minor, a person under legal age. NAIC is a National Association of Insurance Commissioners, which is an organization composed of insurance commissioners from all states and jurisdictions formed to resolve insurance regulatory issues. Basically, who regulates life insurance and the insurance things will be the NAIC. The principal is the face value of the policy, the original amount invested before the earnings. Okay? Any
Okay.
questions those so far? Was any of those confusing?
The one for indemnity?
Indemnity, it's a principle of reimbursement which insurance is based in the event of a loss. So indemnity is, if you lose me, how much will you get? That amount of money will be the indemnity of the loss. So in the indemnización, something happens in an accident, te dan cierta cantidad de dinero and they call it like an indemnity, basically. A loss, una indemnización por lo que pasó. So there is, just like there is types of parts of an application, there are parts of a contract for the contract to be whole and legal and binding. So the entire contract stipulates that the policy, copy of application, along with any writers and amendments that constitutes the entire contract. So entire contract also has 4 parts. Is the policy, the copy of the application, any writers or amendments. Okay, we have what it's called the insuring clause. Insuring clause or insuring agreement sets forth the basic agreement between the insurer and the insured. It states the insurer's promise to pay the death benefit upon the insurer's death. The insuring clause usually is located on the policy face page. I'm gonna fly through more of this, okay? So free lock allows the policy owner a specified number of days from receipt to look over the policy, and if dissatisfied for any reason, return it for the full refund of premium. In the state of Florida, this is things to remember, and you will see it in the exam. A free lock in the state of Florida is 14 days. And that's any contract, not just life insurance. If you sign a contract today with anybody in the state of Florida, legally you have 14 days to kind of decline it, void it, anything for a full refund of the amount that you had given.
Okay.
Consideration, again, we saw that on the key terms for the day, that both parties must provide something of value. So we provide the monthly payments, and then the insurance provides the death benefit. Owner's rights, you'll see it in this graph. Again, if you see the graph, let me see. Oh, you saved to collections, look at that. Parties to a policy and ownership, only policy owners have ownership rights of the policy. So only the person that is paying the premium has rights to the policy. What we mean with rights, we mean changing anything on the contract whatsoever. The insurance company issues the policy to policy owner and pays the benefits to the beneficiary. The beneficiary receives benefit upon insurance death. So the parties to a policy and ownership are 3. You have the policy owner, the insurance company, and the beneficiary. So policy owner pays the premiums and has rights to the contract. The insurance company issues a policy to the policy owner and pays benefits to the beneficiary. And then you have the beneficiary who receives benefits upon the insurance death. So you have those 3 parts. The policy owner has the responsibility of paying the policy premium and is also the person who must have an insurable interest in the insured at the time of the application of the insurance. So that's kind of a recap of the previous chapters that we've seen. Assignments, like we saw before, the policy owner of a life insurance policy has the right to transfer partial or complete ownership of the policy to another person without the consent of the insurer. So the policy owner, the person paying for the contract, has the right to transfer those rights without the consent of the person that's insured. So yo puedo cambiar si tengo un seguro de vida a mi esposo, actually I am the policy owner on his policy. I can change my rights, be like, I'm no longer the owner. Now my kids are the owners and they're the ones paying for the policy without my husband's consent. That's basically what it says, okay? So you have two types of assignments. You have the absolute assignment, which involves transferring all rights of ownership to another person or entity. And this is a permanent and total transfer of all policy rights. So a new policy owner does not need to have insurable interest in the insured. Since the policy is already in place and it's already accepted, there is no longer that need for the insurable interest on the insured. Now you also have the collateral assignment, which involves a transfer of partial rights to another person. It is usually done in order to secure a loan or some other transaction. A collateral assignment is a partial and temporary assignment of some of the policy rights. Once the debt or loan is repaid, the assignment rights are returned to the policy owner. So you have those two. Absolute assignment is just what it means, completely absolute. You transfer the whole thing. You're no longer, you cannot backtrack, be like, oh no, like I want it back. Can't do any of that. It's permanent. You transfer all the rights to a new person. Collateral is mostly used as partial. You can get it back after the debt is paid, and it's mostly used when it's a loan or something like that. So let's watch this one real quick so it explains more the collateral side of things. Let me know if you can hear it, okay?
Gary has taken out a small business loan from ABC Bank. As a condition for the loan, ABC has asked Gary to assign his life insurance policy over to them as collateral. Until the loan is repaid, ABC Bank is the owner of Gary's policy. Once Gary's loan has been repaid, the ownership rights will revert back to Gary. This is called a collateral assignment.
Weird, but it is. People do it. So know this, absolute assignment is a complete and permanent transfer of ownership rights. Collateral assignment is a partial and temporary transfer of rights. Beneficiary designations. The beneficiary is a person or interest to which the policy proceeds will be paid upon the death of the insured. So it can be person, class of person, trusts, things like that. The proceeds are completely tax-free for the person, and it cannot be a minor. If you leave your policy to a minor, it becomes an estate and the kids can't touch it until they're older. Okay, so it becomes like frozen money, basically. Designation by class. A class of beneficiaries using a designation such as my children. The term can be vague if the insurer has been married more than once, has adopted children, or has children out of wedlock. Huh? Oh. An example of a class that is less vague is children of the union of Jane Smith and James Smith. Many insurers encourage the insurer to name each child specifically and to state the percentage of benefit they are to receive. So this is something once the kids are older, I can go back and check because my policy literally says all living children. So it's completely vague, but it's a class that they give you. When naming beneficiaries, it is most prudent to be specific by name, individual, and by designating the exact amount to be given for to each of them. Two classes designations are available for use when an insurer chooses to group the beneficiaries, and it's per capita or per but it's not stripes. Stripes? You see it? Huh? Or is it a typo? So per capita, meaning by the head, evenly distributes benefits among the living named beneficiaries. Per starps, meaning the bloodline, distributes the benefits of a beneficiary who died before the insured to the beneficiary's heirs. Oh, fun. Succession, primary, and contingent. So we've seen when we're doing our fuel training appointments, when they select the primary beneficiary and the contingent beneficiary. So primary beneficiary will get 100% of that death benefit. The only way they don't get it, it's obviously if they pass away. So contingent, it's basically what if the primaries died before the person that's insured, then the contingent will get the money, right? So it's also referred to as secondary. Again, they only will get the money if the primary beneficiary it's not alive. So they have the second claim to it. Now, let's say if husband and wife are in an accident together and they die, both of them die from that accident. You cannot determine who died first or second or anything like that. Does not matter, like the insured passed away, the primary beneficiary passed away. So the one that gets the insurance is the son. Right? So at that point, it's kind of como que se asume que el primero que falleció fue the insured. Yeah. Let's see this so you can see the little card there. It's 23.
Tom has a life insurance policy in which he names his wife Susie as the primary beneficiary and his son as the contingent beneficiary. If Tom and Susie got killed in the same car accident, the death proceeds from the life insurance policy would be payable to the named contingent beneficiary, since the primary beneficiary is no longer living and able to receive the death benefit.
Basically, and so let's do, okay. If no beneficiary is named, the policy proceeds, we go to the insured state. So always know that if they don't name anybody, it will go to the state, and then, you know, whoever the next of kin is has to go to court, prove that they have the rights to the state and all that stuff. So the best thing we can do for our clients is make sure they have the beneficiaries, and it's make sure they always have it up to date. Like if they have more children, or if they got divorced and remarried and things like that, like make sure we're doing that customer service to them, okay? So this is another graph that explains insured, primary, beneficiary, or contingent. So the primary is the first to claim on death benefit if the insured dies. Contingent, second claim on death benefit if the primary beneficiary dies before the insured. Now you have revocable and irrevocable beneficiaries. A revocable beneficiary, you can change that designation at any time. At any time. So most of the time, when I'm doing an application for a customer, we always choose them to be revocable. Why? Because sometimes they put their mom because they're not married, and you know later on they will get married, so it's less paperwork. Or maybe they are naming a sister again because they're not married, or their boyfriend or anything like that. So you want to make it revocable when you know, and it's up to them. Sometimes they'll say it's my mom and I don't want to change it ever. But as long as we explain to them the differences. So revocable, you can always change it. You can go back to your policy at any time, any period, as many times as you want, and change the beneficiary. An irrevocable designation, you cannot change it without the written consent of the beneficiary, which is kind of weird. So for example, I have my policy and I have my husband as my irrevocable beneficiary, and then we get divorced. I will still need his written consent saying that he will no longer be the beneficiary of my policy, and he's allowing me to change the beneficiary on it. Wouldn't that be weird? Asking your ex-husband, be like, hey, you will no longer get this amount of money, and I need your signature because now I want the new husband to get. Yeah. Right? It's kind of weird.
It's
but
so weird.
but it's just so you get it. So irrevocable, it's you're putting somebody there, you cannot change it. You're the policy owner, you're the insured, everything you want. But if that person does not give you their signature, you cannot change the beneficiary of that policy.
Crazy.
Okay. Common disaster clause, when added to the policy, provides that if the insured and the primary beneficiary died in a common disaster, it is presumed that the primary beneficiary died first. So the proceeds will be paid either to the contingent or the insured estate. So this is even if the beneficiary outlived the insured by a few days. So a hurricane hit, the house I was in got taken completely, but my husband, got, I don't know, like injured and outlived me for 5 days. Because the cause of the death is also the hurricane that hit us, it will be presumed that he died first. So my money will go to the contingent beneficiary. So most insurance companies will tell you when you buy this type of clauses that they're gonna either list you the number of days allowed, like 14 days, 30 days, in which it's the difference, or like the days that the primary beneficiary can die after you. Let's go a little bit more. Okay, so modes of premium payments. So note this before we go into premium payment. Common disaster clause protects the contingent beneficiary. So it's a protection to them. Premium payments. Modes. The policy stipulates when the premiums are due, how often they are to be paid, which is monthly, quarterly, semi-annually, or annually, and to whom. The premium mode is the manner of frequency that the policy owner pays the policy premium. Most policies allow for annual, semi-annual, quarterly, or monthly payments. If the insurer selects a premium mode other than annual, there will be an additional charge to offset the loss of earnings, since the company does not have the entire premium at once. So is that understood? Kind of like it's basically how often do you want to pay your policy?
Yeah.
Now we have level or flexible. Most life insurance policies have a level premium. We saw that the other day, which means that the premium remains the same throughout the duration of the contract. Flexible premium, however, policies allow the policy owner to increase or decrease the premium during the policy period. Now you also have something called a grace period. The grace period is the period of time after the premium due date that the policy owner has to pay the premium before the policy lapses. This is normally 30 or 31 days, like a month. You can miss one payment and your policy will not lapse. It's like, a car payment as well. I know you have a due date, but in the bottom says late fee will be charged after 10 days. Those 10 days are your grace period. And this one, since there's no late fees, there is basically cancellation. Right? So grace period protects policyholders from losing insurance coverage if they're late on a premium payment. Then you have the reinstatement. The reinstatement provision allows a lapsed policy to put back in force. The maximum time limit for reinstatement is usually 3 years after the policy has lapsed. So even if it lapses, you have up to 3 years, depending on what your contract says and what company you use, to put it back in force. Most of the time, obviously, they're going to ask you for that, for the premium for those years to be paid in order to put it back. So you'll ask maybe what is the benefit of reinstating a policy after 2 years that I haven't paid? Now I have to come up with 2 years worth of premium. You do, but the benefit is you get it reinstated at the rate that you had it back then. If you were to buy a new policy, you have to do all new exams. You have to do all new calculation based on the attained age at the time that you're applying for it. Now, a policy that has been surrendered cannot be reinstated, just to keep that in mind. Incontestability clause prevents an insurer from denying a claim due to statements in the application after the policy has been in force for 2 years. Even if there has been a material misstatement of facts or concealment of a material fact during the first 2 years of the policy, an insurer may contest a claim if the insurer feels that the inaccurate or misleading information was provided in the application. The incontestability period does not apply in the event of non-payment of premiums, and it also does not usually apply to statements related to age, sex, or identity. So the period for incontestability is 2 years. And this is why they're super hard on underwriting, because if something kind of like se les olvidó, se les pasó chequear, era mentira y no se dieron cuenta, después de los 2 años, no te pueden decir nada. Unless you lied about your age, your sex, or your identity. Like those are the only 3. Identity being like background and stuff like that. O quién eres o representación. Misstatement of age on the application will result in the adjustment of premiums or benefits. So I think we said that the other day, like if we are like 5-10 years difference and you've been paying for so long, they'll be like, hey, based on what you pay, your benefit would have been this amount. They can change that or be, hey, you owe me this amount of money in premiums if you want to keep the same benefit. Policy loans and withdrawals. The policy loan option is found only in policies that contain cash value. The policy owner is entitled to borrow an amount equal to the available cash value. Any outstanding loans and accrued interest will be deducted from the policy proceeds upon the insurance death. So, si le sacaste dinero o si retiraste dinero de esas cuentas y falleciste antes de pagarlo, antes de que paguen el beneficio del seguro, le van a descontar el loans outstanding, cualquier interés que hayas tenido o cualquier penalidad que tengas. And then the difference of that, they'll pay out to your beneficiaries. However, the insurer must provide 30 days written notice to the policy owner that the policy is going to lapse. It says the policy will not lapse with an outstanding policy loan unless the amount of the loan and accrued interest exceeds the value, the available cash value. So, si le quitaste tanto dinero que ya, como que no tenías y tienes un préstamo mucho más grande que el dinero que está ahí, your policy can lapse because now you owe them too much. It says, however, they need to provide you with a 30 days written notice that it's going to lapse to give you kind of a chance to pay back. Insurance companies may defer a policy loan request for up to 6 months, unless the reason for the loan is to pay the policy premium. Policy loans are not subject to income tax. And so policy loans are only available in policies that have cash value, which we know them, as well as whole life, okay? Automatic premium loans. The automatic premium loan provision is not required, but is commonly added to contracts with a cash value and no additional charge. This is a special type of loan that prevents the unintentional lapse of a policy due to non-payment of the premium. For example, a loan against the policy cash value for the amount of premium due is automatically generated by the insurer when the policy owner has not paid the premium by the end of the premium paying grace period. All it says is that they're automatically putting a clause on those cash value policies that says if you lapse and you forgot to pay the premium, we're going to take from your savings account from that cash value to pay the premium after the grace period. So if the grace period was a full month, after that full month, you still have not paid. So after June is over, you still have not paid your May. They're going to go into that cash value account and pull to cover May. By the end of July, if you haven't June, they'll go ahead and do the same, pull to cover June. Let's see, exclusion. Exclusions are causes of losses, exposures, conditions listed in the policy which are not covered and with no benefits payable. So these are the types of risks that the policy will not cover. Certain exclusions are standard for all policies, while others are attached to the policy as an exclusion rider. The most common exclusions found in life insurance policy are aviation, hazardous occupation, and war and military service. So aviation, most life insurance will cover an insured as a fare-paying passenger or a pilot on a regularly scheduled airline, but will exclude coverage for non-commercial pilots or require an additional premium for the coverage. which means is if your job is being a pilot for American Airlines and something happens on the plane, you crash and you passed away, it will go ahead and cover because that was your job. Meaning you had disclosed that in the beginning and your premiums were as if you had that occupation. Now, if you were and flew like a private helicopter somewhere and you died, then that's not covered. It's an exclusion because then you went in and did something that was risk and maybe you didn't put it in your policy. And this is why it's very important to know the exclusions that each policy has and kind of the hobbies, know our customers. What are the type of hobbies? ¿Qué les gusta hacer? ¿En qué les gusta aventurarse? Para saber si van a estar cubiertos o no. Hazardous hobbies, if the insurer is engaged in a hazardous occupation or participates in hazardous hobbies such as skydiving or auto racing and things like that. So what we were talking the other day, like if they're part of those, then they get either higher premiums for it, and if they not disclosed it, because that's one of the questions in the policy, if they did not disclose that they like to do those activities and they happen to pass away doing any of those, the policy will not pay out. War or military service, most life insurance policies issued today do not exclude military service. However, there are actually two different types of exclusions that may be used to limit the death benefit if the insured dies as a result of war or while serving in the military. The status clause excludes all causes of death while the insured is on active duty in the military. The results clause only excludes the death benefit if the insured is killed as a result of an act of war, declared or undeclared, the war meaning. So I think that is why most military people have their military insurance, because then it has more details to what they're doing. But this one, most of the life insurance, it do not exclude their service. However, they can have these two type of clauses. Status clause, which excludes all causes of death while the insurer is on active duty in the military, and the results, which will be just a result of war. The suicide, I think you'll find in all of them. Suicide provision life insurance policy protects the insurers. It protects basically the insurance company from getting a client that's very suicidal and just wants to buy a $500,000 policy today, get it in effect today, so they can go and commit suicide tomorrow and the family gets all that money. So suicide clause, it put into an effect for 2 years. So you can buy a policy, you cannot, if you commit suicide between those 2 years or during those 2 years, it will not pay out. If it's 2 years and 1 day and you happen to commit suicide, it will pay out. Please do not commit suicide, call somebody or talk to somebody, okay? Never the answer. Policy writers are written modifications attached to a policy that provide benefits not found in the original policy. Sometimes they require an additional premium, but they also help tailor a policy to a specific needs of the insured. So you have a few writers that we're going to cover here. One of them is the child writer that we were talking before. You also have disability writers. So some writers provide benefits in the event of the insured's disability, while other writers provide for partial payment of the death benefit prior to the insurance death. That's called accelerated or living benefit writers. So the waiver of premium, and that's something I always tell my customers to get, the waiver of premium writer waives the premium for the policy if the insured becomes totally disabled. So most insurance, and our insurance does as well, has a 6-month waiting period. So what it is your doctor says you're disabled, you have 6 months that you're still paying your policy. At the 7th month, the company says, okay, yes, we reviewed the whole paperwork, you are fully disabled. We'll go ahead and pick up the premium. And they pay the premium while, they pay the premium throughout the whole thing. If you're back on the workforce and happen to be back, then you can pick up and pay them again. But if not, your company will pay it and you're fully covered. So just to be more specific, says most insurance impose a 6-month waiting period from the time of disability until the first premium is waived. And then if you're still disabled after the 6 months, they go ahead and pay it up to age 65. Waiver of premium rider waives the premium of a total disability after the waiting period. So it will start waiving at month 7 from the disability. Waiver of monthly deduction rider pays all monthly deductions while the insured is disabled. So it will pay, give me 1 second. Okay, the waiver of monthly deductions rider pays all monthly deductions while the insured is disabled after the 6-month waiting period. So if we remember what type of policies have deductions or monthly deductions and fees are usually the ones with the cash value. And so, and this is what it says, this rider is usually found on the universal life policy. So monthly deductions include the actual cost of insurance charges, expense charges, and costs or charges for any benefits added to the policy by rider. Then we have what's called a disability income rider. In the event of a disability, the insurer will waive the policy premiums and pay a monthly income to the insured. So there, and that will be the difference between 1TC disability, right? It will be either the waiver of premium, which waives the premium if you're disabled, and the disability income, that on top of waiving your premium, it also gives you income while you're disabled. Then you have payer benefits. Rider is primarily used with juvenile policies and the life insurance written on the life of a minor. So otherwise it functions like the waiver of premium rider. If the payer, usually a parent or guardian, becomes disabled for at least 6 months or died, then the insurance will waive the premiums until a minor reaches an age or like 21. So it's a payer benefit. If I have the waiver of premium and I become disabled, not only my policy will become waived at the month 7th, but also my kids' policies. Like the company will pay them until my children are 21, and at that age, they're expected to go ahead and pick up the premium of their own policies. The other insured rider provides coverage for one or more family members other than the insured. The rider is usually level term insurance attached to the base policy covering the insured. This is also known as a family rider. If the rider covers just the spouse of the insured, it can be specified as a spouse term rider and allows the spouse to be added to the coverage for a limited period of time and for a specified amount. And it usually expires when the spouse reaches age 65. The children's term rider allows children of the insured, natural, adopted, or stepchildren to be added to coverage for a limited period of time for a specified amount as well. This coverage is also term insurance and usually expires when the minor reaches age 18 or 21. Most riders provide the minor with the option of converting to a permanent policy without evidence of insurability. So they have the right at age 18 or 21 to go ahead and turn or convert their policy from a rider to a full-on policy without the evidence of insurability. So God forbids they get diagnosed with any type of illness, they don't need to disclose any of that, and they can still will have their life insurance in place. Children's term riders provide temporary life insurance coverage on all children of the family for one premium. The premium does not change on the inclusion of additional children. It is based on an average number of children. So children's term rider is one premium for all children. Your rider will be the same amount, even if you have 1, 3, 5, or 10 kids. So let's do kind of stop there. Go up and do quizzes so we don't lose it, okay? Because a lot of concepts as well.
Okay.
So, let's go up. Let's do a few quizzes. That way we can retain a little bit more. Okay. So according to the entire contract provision, a policy must contain
A.
the application. Perfect. A little bit down. It's the same question. I say it's because the beginning we saw them a lot. Okay. Which provision of a life insurance policy states that the insurer's duty to pay benefits upon the death of the insured and to whom the benefits will be paid? So which provision of a life insurance policy states that the insurer's duty to pay benefits upon the death of the insured and to whom the benefits will be paid? Is that the consideration clause, the insurance clause, the entire contract clause, or the beneficiary clause?
A.
Consideration clause, what do you think? What are you thinking? What does, I don't know if Patty and Mildred, what do they think? Should we go with,
Or you can change the back again.
yeah,
In order to the contract to be valid, consideration. Insures the premium. I don't remember what was the insurance clause.
yeah, I don't think we have, it's not in there. An insurance clause is not in there, and entire contract clause, it's another one that's not there. So consideration, and we saw it, I think in chapter 2 as well, is I pay your premium, you give me a death benefit, right? So which provision of a life insurance policy states that the insurer's duty to pay benefits upon the death of the insured and to whom the benefits will be paid?
Or D, ain't it?
So the beneficiary?
I think it's beneficiary as well.
Because it states who pay it to.
It says, so, and that's what it, and to whom the benefits will be paid.
Insurance clause.
Where was the insurance clause in here? Did we like completely, oh, it's right here. So the insurance clause states that the insurer agrees to provide life insurance for the named insured, which will be paid to a designated beneficiary when proof of loss is received by the insurer. It states the party to be covered by the policy and names of the beneficiary who will receive the policy. Okay, so let's close this one. Between the insurer and the insured, it states the insurance promised to pay the death benefit upon the insurance death. The insurance clause usually is located on the policy face page and also defines who the parties to the contract are, how long coverage is enforced, and the type of loss against it. Type of loss insurance against. Huh. Okay, let's do in there again. The provision which states that both the policy and a copy of the application form the contract between the policy owner and the insurer is called the aleatory contract, complete contract, entire contract, or total contract.
The entire contract.
See?
Good. Perfect. Entire contract. Let's move only a little bit to see if it gives it. This is the same question. What is the purpose of a free look period in insurance policy? Free look period in insurance policy. It allows the insured to reject the policy with a full refund. It allows the insured 10 days to pay the initial premium. It allows the insurer to temporarily suspend coverage after an insured's disability. It allows the insurer to cancel coverage if a misrepresentation is discovered.
A.
Hey,
Good job, ladies. Good job. And just to add it, in the state of Florida, how many days do you have?
14.
14.
Good. Perfect. Oh, it's the same one. A little bit. Which provision of a life insurance policy states the insurer's duty to pay benefits upon the death of the insured and to whom the benefits will be paid?
Insurance clause.
Perfect. We're so smart.
We just got that one.
Shh. Regarding the free look provision, the insurance company must issue a free policy for 10 days, must allow the policy owner to return the policy for a full refund, cannot charge a premium after 10 days, must issue a free policy for 30 to 31 days.
Must allow the policy owner to return the policy for a full refund.
Perfect. Which of the following explains the policy owner's right to change beneficiaries, choose options, and receive proceeds of a policy? Is that the owner's rights, the entire contract provision, the consideration clause, or the assignment rights? Which of the following explains the policy owner's right to change beneficiaries, choose options, and receive proceeds of a policy?
Is that the owner's right here? The entire
I'm
contract,
between owner or not consideration.
assignment
And-
right.
Assignment right or owner's right? That's what I'm between.
So assignment rights is when you assign, basically you transfer the rights of the policy. So you're no longer the owner, you're changing it away. Like you're transferring to somebody else, whether it's absolute
Okay.
or the collateral. I think you guys are right on the owners. Yep. Policy owner can learn about the ownership rights by referring to their policy. Which of the following statement is true about a policy assignment? It permits the beneficiary to designate the person to receive the benefits. It authorizes an agent to modify the policy. It transfers rights of ownership from the owner to another person. It is the same as a beneficiary designation.
I think it's D.
Ellie says C.
It transfers the right ownership from the ownership to another person.
I think it's C also.
So assignment, it's when you are assigning it to somebody else. You're transferring the rights.
Okay.
So that's the policy owner has the right to assign the policy. So absolute complete change or collateral when you're putting it as part of a debt. Or like to cover a debt, basically. Let's see. The two types of assignments are complete and proportionate, absolute and collateral, absolute and partial, complete and partial.
B.
Perfect. Absolute, again, assigns the entire policy. Collateral assigns a part or all of the benefits. Which of the following information will be stated in the consideration clause of a life insurance policy? A, the amount of premium payment. B, the parties to the contract. C, the time period allowed for the payment of premium. D, the conditions for insurability. Ah,
I feel like it's all of them.
right? So consideration clause, right? It's when we're talking about consideration. Consideration is when you have, I pay you this for that.
I'm gonna go with A.
Yeah, A, the amount of payment.
Yep. So it has to have specifically that amount in there. Perfect, ladies. What would be an advantage to naming a contingent or secondary beneficiary in a life insurance policy? A, it allows creditors to receive payment out of the proceeds. B, it ensures the policy proceeds will be split between the primary and contingent beneficiaries. C, it requires that someone who is not the primary beneficiary handles the estate. D, it determines who receives policy benefits if the primary beneficiary is deceased.
It's
It's
D.
D.
I love it how Ellie was like,
We can hear her.
Perfect. So naming the secondary beneficiary basically will protect those proceeds if the primary is deceased. Let's keep on going. What would be the same question? I'm gonna rewatch this and just laugh. In a case where the primary beneficiary predeceases the insured, in the event of the insurance death, the death benefit proceeds will be paid to the contingent beneficiary, the insured spouse, the policy owner, or the insurance company.
In case for primary benefit receipts.
So in the case primary pre, always think as before diseases. So murió antes que el asegurado. So my
So that's
primary
gonna go to
the contingent. Yeah, to the second one. Yep. Goes to the contingent beneficiary. Which of the following is true about a class designation? It determines the subsection of beneficiaries. B, beneficiaries are not identified by name. C, beneficiaries must be part of the insured's immediate family. D, it is not allowed. I don't even know what that one means.
I don't know.
So think about class. Remember when we're talking in the classes of beneficiary, one of them says all living children. So think about that as one of the classes, so see if it helps you. So if you have all living children as a designation for your beneficiary, then
Oh, it'll be B because they're not identifying them by name.
correct. You're not identifying them by name. I don't even, so sucesión? What does that mean?
Succession of beneficiaries.
Is that like a list? Primero ese, después ese, después ese, después ese? I have to look it up. Sorry, my English is not very good. Hold on. That's why I didn't.
Yeah, the better we know. I mean, we need to know each. What about it would have came up on the test? We'd be all confused.
There's a number of people or things sharing a specified characteristics and following one after the other. So I was right. It's this, and then that one, and then that one, and then that one, and then that one.
Gotcha.
So but there is a first one, and then there's a second one, and then there's a third one. So technically, when you have the all living children, it's all of them at the same time for the same amount, right? Okay, a little bit more. A policy owner who is also the insured wants to name her husband as the beneficiary of her policy. She also wishes to retain all of the rights of ownership. The policy owner should have her husband named as the irrevocable beneficiary, revocable beneficiary, secondary beneficiary, or contingent beneficiary.
She
So let's
wishes
read-
to never change it, right?
What?
She says she never wished to change it.
She also wishes to retain all the rights of ownership.
So
So you
that's
retain the rights of
B.
ownership means you can change everything.
So B. B.
Revocable, yes. So off the bat, what I wanted to say, basically, it's secondary and contingent beneficiary mean the same thing. So you can automatically eliminate both because there is no reason why they should be giving you the same option in there. So it'll be a revocable beneficiary.
Yeah, when I first heard the ownership, I thought about irrevocable or revocable. I didn't even look at C or D.
And so in the when you're sitting for the exam, it's kind of like read the question twice and then automatically eliminate two. In this case, secondary and contingent, out of the question. Like that's not even, it's not even in there. Okay. A little bit more. What is a clause that describes the method of paying the death benefit in the event that the insured and beneficiary are both killed in the same accident?
Common disaster clause?
What is a clause that describes the method of paying death benefit in the event that insurance and beneficiary both killed in the same? We have common disaster clause, spendthrift clause, settlement clause, and non-forfeiture clause.
The
So-
common disaster?
Okay, yeah, you're both telling me common disaster it is, provides that if the primary dies before the insured, les dan un lapso de tiempo para hacerlo al revés, para que el dinero vaya al contingent. Let's go to reinstatement. Which of the following statements about the reinstatement provision is true? It provides for reinstatement of a policy regardless of the insured's health. B, it guarantees the reinstatement of a policy that has been surrendered for cash. C, it requires the policy owner to pay all overdue premiums with interest before the policy is reinstated. D, it permits reinstatement within 10 years after a policy has lapsed.
See? It requires policy to pay all overdue premiums.
The only thing that's throwing me off with that one is that they wouldn't charge you interest. That's the only thing that's throwing me off about that option.
It guarantees.
So I think when we're talking about it, it's it allows you to keep your policy at the same rate with the same terms because you don't need to prove insurability again. So I personally think it's A. Should we
So
try
even
it?
though you reinstate it, like let's say 2 years later, you still don't need to be okay.
It gives you, that's what it says. It's usually the term is 3 years. Again, every contract will be different. Like every insurance company will be different, but normally it's a maximum of 3 years. So that automatically D will be out of the question. 10 years.
Okay.
B will be out of the question as well because a policy cannot be reinstated after it's been surrendered, meaning you already gave it in for the cash value of it. Like, you know, once that transaction happens and you got your cash, you can no longer reinstate that policy. So in this scenario, B and D will be completely out of the question. So let's see if it's A. You guys were right with the interest. And that's one thing that was throwing me off.
I was right. Okay.
Yeah.
So
Lily was telling me C too. I'm like, So hold on, let's go back to it because I thought, oh no, if the policy owner elects to reinstate the policy, he or she will have to provide evidence of insurability. So you do have to prove again that you are healthy enough for the policy.
Oh, premiums plus interest.
And interest. Huh. That's what happens when you read so fast and you skim through the things. But let's see if we get it again. So it's good to know because it's the policy. Think about it as an insurance company. You're protecting what you're insuring. Like you're protecting basically your business. If you let your policy lapse, right, and it's lapsed for a year, and God forbid now you're diagnosed with cancer and you're trying to get your policy back, me as an insurance company is going to be like, well, kind of fishy that you let it go for a full year and now you're like wanting it back. Why? Let's make sure you're healthy and like you're not trying to pull a fast one on the company, basically. And then if you're healthy again, just pay back all the premiums and interest and things like that. Who can request changes in premium payments, face value, loans, and policy plans? Will that be the beneficiary, the producer, the policy owner, or the contingent beneficiary?
The policy owner.
So which two would you completely eliminate from this question if you were sitting on the test?
The beneficiary and the contingent beneficiary.
Yeah.
A and D.
A and D. Yep. The validity of coverage under a life insurance policy may not be contested, except for non-payment of premium, after the policy has been in force for at least how many years? So Ellie says 2.
Non-payment of premium. It has been enforced.
So you see,
that falls on the 2-year thing.
Yeah, they're talking about the incontestability. You see, it may not be contested. So it's talking about the incontestability period, which is 2 years. A little bit more. Which of the following components must a life insurance policy have to allow policy loans? Which of the following components must a life insurance policy have to allow policy loans? Will that be perfect? If a policy has an automatic premium loan provision, what happens if the insured dies before the loan is paid back? A, the policy is rendered null and void. B, the balance of the loan will be taken out of the death benefit. C, the policy beneficiary receives the full death benefit. D, the policy beneficiary takes over the loan payments. Ellie
B.
said B. Yes. Balance of the loan will be taken out of the death benefit. If an insured continually uses the automatic premium loan option to pay the policy premium, A, the face amount of the policy will be reduced by the automatic premium loan amount. B, the cash value will continue to increase. C, the insurer will increase the premium amount. D, the policy will terminate when the cash value is reduced to nothing. So if an insurer continually uses the automatic premium loan option, so just stop there and think, what is the automatic premium loan option, right? It's that clause that they put into the cash value policies that says if you lapse on your policy after 30 days of that grace period, we can go ahead and grab from your cash value to pay the insured, right? It wouldn't, if you still have money here to pay from your savings to the insurance, they'll keep allowing it. But once that savings is the,
Well, it's gonna be D because it's gonna end somehow.
yes. So if you don't keep feeding it money, once that cash value goes down to zero, there is no longer a way to pull after that grace period again, then that policy completely lapsed. Items stipulated in the contract that the insurer will not provide coverage for are found in A, insurance clause, B, benefit payment clause, C, consideration clause, D, exclusion clause.
Exclusion cost.
Yes. And a way to see it, it will not provide coverage for, and those are all the exclusions that it will have. So exclusions, remember, are restrictions of coverage as stated in the policy. What is the waiting period on a waiver premium rider in life insurance policies?
What is the waiting period for waiver? Waiver. Is
At
that
least
6 months?
months. Yep, there we go, 6 months. And that's most insurance, okay? So most insurance companies will have that 6-month premium. It might be that one has a different number, but for most, like como que la ley universal for the exam will be 6 months. A policy owner fails to pay the premium due on his whole life policy after the gray period lapses, but the policy remains in force. This is due to what provision? A, automatic premium loan. B, waiver of premium. C, incontestability period. D, assignment.
A, automatic premium loan.
Yes, Ellie said the same thing. Perfect. What is the name of a clause that is included in a policy that limits or eliminates the death benefit if the insured dies as a result of war or while serving in the military? A, aviation. B, hazardous occupation. C, war or military service. D, limited benefit.
C.
War or military service. Yep, that was kind of a giveaway.
Yep.
Which of the following is true about the premium on the children's rider in a life insurance policy? A, it increases when a newborn baby is added to the policy. B, it decreases when an adopted child is added to the policy. C, it remains the same no matter how many children are added to the policy. D, it decreases when the oldest child reaches the age of 21.
C, it remains the same no matter how many children are added to the policy.
Yes, perfect. Which rider, when attached to a permanent life insurance policy, provides an amount of insurance on every family member? A, family term rider. B, spouse rider. C, children's rider. Or D, additional insured rider.
Or what? I am between A or D.
You said which one, family?
D. Oh.
Family. So it said every family member, I know como Latinos pensamos en nuestros tíos, primos, sobrinos, and things like that. The policy basically is only considering your spouse and kids. Yeah, your immediate family only.
Okay.
But what is true about a spouse term rider? A, coverage is allowed up to age 75. B, the rider is usually level term insurance. C, coverage is allowed for an unlimited time. D, the rider is decreasing term insurance.
Spouse term.
It's 65, not
It's
It's 65, not 75, so A is out of the question.
and it's not unlimited.
It's not unlimited time. That one gives you, so A and C are out.
so B.
That says B, and it is B. So all like child rider, spouse rider, those are all Bs. I mean, those are all level term. I think we are, I think that's as far as we got, yeah. I think we actually went a little bit further down. Okay, so we were, yes, we were in the family rider. So again, family term is equal spouse and children. Okay, it could be adoptive stepkids and things like that, but it does not refer to nieces and nephews and things like that. Riders affecting the death benefit amount. Now we're going into those riders. The first one is accidental death and dismemberment. Accidental death rider pays some multiple of the face amount if death is a result of an accident as defined in the policy. Death must usually occur within 90 days of such accident, and the benefit is normally 2 times, which means double in indemnity of the face amount. Some policies may pay triple the face amount for accidental death. So if you have that rider in your policy and you happen to die in a car crash or any other type of accident, then instead of paying the face amount, it can pay double or triple the face amount. Each policy specifies what will be considered accidental death. So you have to watch for that because you might think you have the accidental death rider, but you in these policies you really have to read exactly what it will mean. So accidental death does not include death that results from any health problem or disabilities. In addition, death that result from self-inflicted injuries, war hobbies, or avocations are usually not covered. They will be covered under the base policy unless specifically excluded. So, see, this one is the accidental clause. But let's say you went bungee jumping, an accident happened, and you passed away. And now your policy has the exclusion of those type of hobbies, even though you die from an accident because it was doing those types of activities, it will not pay whatsoever. Now, the rider often expires at the age of 65, and no additional cash value is accumulated as a result of the rider. So if you didn't die of an accident by age of 65, that does not mean that somehow your cash value went up or that your death benefit overall went up. Now, accidental death and dismemberment pays a principal for accidental death and pays a percentage of that amount or a capital sum for accidental dismemberment. The accidental death portion is the same as the already discussed with the accidental death rider. So what we just discussed up to now, it will be the same for this one, which is for the AD&D. But now the dismemberment portion of the rider will usually determine the amount of the benefit according to the severity of the injury. The full principal amount will usually be paid for the loss of 2 hands, 2 arms, 2 legs, or the loss of vision in both eyes. A capital amount is usually limited to half the face value and is payable in the event of the loss of 1 hand, arm, leg, or eye. Dismemberment can be defined differently by the insurance company from the actual severance of the limb of the loss of use. So if you lose a finger, it's not going to pay out. But if you lose the whole hand, depending on what it says on your insurance, it might. Some insurance go as far as saying that it will only pay if it's your dominant hand. So if you happen to lose your left hand, it will not pay. So you have to really, know how to teach your customers how to read those clauses, because some people may say, oh, I even have this rider and it's for less amount of money. But then when you go and you go and read it, it says kind of funny things like that, like it will not pay as the client will think it will pay. Guaranteed insurability rider allows the insured to purchase additional coverage at specific future dates, usually every 3 years, or events such as marriage or birth of a child, without evidence of insurability or an additional premium. So that means you're paying additionally per month now, but your clause says, hey, when you get married, you can increase your death benefit without proving insurability as well. Or when you have a kid, you can increase your death benefit without proving insurability. Return of premium, I think we saw this yesterday, is implemented by using increasing term insurance. When added to a whole life policy, it provides that at death prior to a given age, not only it's the original amount payable, but an amount equal to all premiums previously paid is also payable. So this rider usually expires at a specified age, such as age 60. I know we're also looking at it as when they buy it like for a certain period of years, and it's a much more expensive type of policy. Now we have term riders. Allows for an additional amount of temporary insurance to be provided. So accelerated living benefits and long-term care riders allow the early payment of a portion of the death benefit if the insured has any of the following conditions: a terminal illness, medical conditions that requires an extraordinary medical intervention, such as a transplant, a medical condition that without extensive treatment drastically limits the insured's lifetime, inability to perform activities of daily living, permanent institutionalization, whoa, that's a mouthful, or confinement to a long-term care facility, or any other conditions approved by the Department of Insurance. So our policies do have this. They pay up to, I believe is 40 or 70%, depending on the terminal illness that you have. So they'll pay a certain amount of money now. If you have let's say you get diagnosed with cancer and you're only given 6 months to live because it's like, that's the max, you can request by showing proof that you have a terminal illness up to a certain percentage of your life policy, and then the remainder will be paid at death. Living needs rider provides for the payment of parts of the policy death benefit if the insured is diagnosed with a terminal illness that will result in death within 2 years. The purpose of this rider is to provide the insured with the necessary funds to take care of necessary medical and nursing home expenses that incur as a result of the terminal illness. Honestly, if I get a terminal illness, I'm not paying for any medical thing. I'm gonna go and see the world with the last few months that I had. Wait, hold it. Accelerated benefit is equal to early payment of parts of death benefit to the insured from the insured for qualifying medical expenses. LTC is long-term care coverage, which is often purchased as a separate policy, but can also be marketed as a rider to the life insurance policy. So it is what it's saying, it will pay for the long-term care facilities. And if it's a rider, whatever you're pulling for that will be deducted from the death benefit at the end. Effect on death benefit: if an insured withdraws a portion of the face amount by the use of any of these riders that we said right now, then it's the same as what we've been discussing basically. So the payable death benefit, it's equals to the face amount minus any amount withdrawn or any of these riders. In a term of cash policy, which is the equation that we have now, it's the face minus the amount withdrawn minus the earnings lost by the insurers in interest. So if you lost that amount of money, how much would you have earned if that money was in? They also kind of deduct that in there, okay? I'm sorry? Just say. I think we have, unless this is super long, no, todavía falta, yeah. Yeah, we're almost there. We're almost there. We're past the half point. Then we have cost of living. Cost of living rider addresses the inflation factor by automatically increasing the amount of insurance without evidence of insurability from the insured. The face value of the policy may be increased by a cost of living factor tied to an inflation index, such as a consumer price index. So here is a breakdown of the most common riders available in life insurance. I can do this with this one. I'm gonna just take a quick cheat sheet, basically. And if I take them and then you see that I'm not sending them, remind me to send them, please. I'll send it to you. Okay, so we have the disability riders, which are the waiver of premium, waiver of monthly deduction, payer benefit, disability income, and accelerated living benefit. Riders covering additional insured, which they cover the spouse, the children, the family, or the non-family, and rider affecting the death benefit are accelerated death benefit, accidental death, or AD&D, guaranteed insurability, return of premium, and terms rider. Any questions so far about those?
No, no questions so far.
We're good. So we're moving into policy on policy options. I want to do quick questions real quick on these ones, on those riders in there. So it's rider affecting death benefit amounts. They start here. Which of the following allows the insured to relieve a minor insured from premiums payments if the minor's parents have died or become disabled? So A, juvenile premium provision, B, waiver of premium, C, payer benefit, D, jumping juvenile. So that just caught me off guard. I'm like, what?
C.
Yes. So waiver of premium will basically cover me. If I become disabled, it will take care of my premiums at month 7. So after a 6-month waiting period. And if I have any child riders, it will cover the payer benefit. Will cover them until the age of 21. A little bit more down. Which of the following is true about the premium on children's rider in a life insurance policy? A, it increases when a newborn baby is added. I think we saw this one, right?
Yeah, C.
C, remains, yep. Which of the following, pero caramba, we just saw it. Okay, an individual is purchasing a permanent life insurance policy with a face value of $25,000. While this is all the insurance that he can afford at this time, he wants to be sure that additional coverage will be available in the future. Which of the following options should be included in the policy? Will it be the guaranteed renewable option, the non-forfeiture options, the guaranteed insurability option, or the dividend options?
Ooh.
All right, so you can take those out. Ellie says we haven't seen B or D yet.
D.
Mm-hmm.
So guarantee insurability. Well,
Insurability option. Let's see. Yes.
yes, yeah.
So with guaranteeing insurability, you're guaranteeing that you wouldn't have to prove insurability later on. So you're guaranteeing that you can increase that premium later on. Actually, the benefit. I think we just did that one. Which of the following statements is true concerning the accidental death rider? A, it will double or triple the face amount. B, it is also known as a triple indemnity rider. C, the rider is only available to insureds over the age of 65. D, it is only available in group insurance.
It will pay double or triple for the face amount?
The face amount. Yes, perfect. It will pay double or triple the face amount. Accelerated living, we just saw this question. Okay, What type of insurance will be used for return of premium rider? A, increase in term, B, level term, C, decrease in term, D, annually renewable term.
Is C?
I think it's A.
A?
Vamos a
I
subir.
don't remember that one.
Yeah, I think it said, yeah, using increase in term insurance. Increase in term, yeah. Okay, so we're over here. Let's see que nos sale. Okay, an insured purchased a 15-year level term life insurance policy with a face amount of 100,000. The policy contained an accidental death rider, offering a double indemnity. The insured was severely injured in an auto accident and after 10 weeks of hospitalization, died from the injuries. How much will the beneficiary receive from the policy? A, 0, B, 100, C, 200, D, 100 plus the total of premiums paid.
D?
Let's see, the policy contained an accidental death rider offering a double indemnity benefit. The insured was severely injured.
Oh, it's double. So that would be C.
Okay. So,
No.
90 days. Yep. It will be, it wouldn't be 0. It will be the 100,000.
You see, I told you 200 because of the double.
Oh, I'm here thinking 10 weeks is more than 90 days. Sure. 10 weeks times
Double
70. It's 70.
That's what I was saying, yeah.
So, okay, this is an example of very kind of fully read all the questions in detail because it is 200, because Ellie was saying the same thing, it's 200, but then it has to be 90 days. And in my head, I'm thinking, I don't know why 10 weeks is more than 90 days, but obviously 10 times 70 is 70. Oh, Dios mío. Okay, if a life policy allows the policy owner to make periodic additions to the face amount at standard rates without proven insurability, the policy includes A, paid up additions option, B, cost of living provision, C, non-forfeiture option, D, guaranteed insurability rider. So if a life policy allows the policy owner to make, I think so too. Ellie says it's guaranteed insurability rider.
Okay, we'll go with her because I really don't know this one.
Guaranteed insurability. So kind of you're making periodic additions to the face value, to the face amount, and meaning you're increasing it, right? Without proven insurability. So then it will be the guaranteed insurability. Do you think we still have more? No, it has different thing. Okay, the insured under 100,000 life insurance policy with a triple indemnity rider for accidental death was killed in a car accident. It was determined that the accident was his fault. The triple indemnity rider in the policy specifies that the death must not be contributed to by the insured in any manner. In this case, what will the policy beneficiary receive?
I think the triple because
Ellie says just 100. So what do you think?
I think it's the triple because it says the triple indemnity rider in the policy specified that death must not be contributed.
Contributed by the insured. That means que yo no, yo no puedo haber causado el accidente.
Oh, so it was his fault, wasn't it?
It was his fault, yeah. So let's see. Yep.
We gotta read these things like 2 or 3 times.
Yes, and always do that when you're sitting for the exam. Read it at least twice, and make sure you understand what they're asking you, because sometimes they're asking things that are weird. If an insured withdraws a portion of the face amount in the form of accelerated benefits because of a terminal illness, how will that affect the payable death benefit from the policy? A, the death benefit will be the same as the original face amount. B, the death benefit will be larger. C, the death benefit will be smaller. D, the death benefit will be forfeited. Yeah, that.
If insurance withdraws a portion.
So if you withdraw a portion of your insurance, of your face amount in the form of accelerated benefits because of terminal illness, how will that affect what, like once you pass away, how will the loan that you took, not, or actually no loan, the accelerated benefits that you took, how will it affect the death benefit that your beneficiary will get?
A, it would
It won't because of the terminal illness.
So what are you thinking?
Something they won't.
What do you guys think?
because it will affect the payable death. It
It's not larger than what before.
So it won't be C or D, I mean B or D. Those are automatically out of the question. Now this one, even though it's
I
a
think
right,
it's C.
you think is what?
C.
C? Yes.
no, she said okay.
Or which one does she say? C, Charlie? Charlie out? C,
C,
out?
Charlie.
Charlie? Yeah, it'll be smaller. And I'm covering the kind of the equation here. So payable death benefit is equal to the face amount minus any amount withdrawn. And it could be from any of the riders that they have. So even though it's a benefit in your clause, it is a benefit. You're not paying extra for it, but it basically, whatever amount you get, it will deduct it from your death benefit. See here. If a life policy allows the policy owner to make wages, so this one. Yes, without proving insurability. A life policy allows the policy owner to make, but it's the same question.
Yeah.
Okay, we're going into policy options now. Non-forfeiture options, which we saw that word in a lot of things. So because permanent life insurance policies have cash values, certain guarantees are built into the policy that cannot be forfeited by the policy owner. These guarantees, known as non-forfeiture values, are required by state law to be included in the policy. A table showing the non-forfeiture values for a minimum period of 20 years must be included in the policy. The policy owner chooses one of the following non-forfeiture options: cash surrender value, reduced paid-up insurance, or extended term. So let's look at this little video over here.
As you have already learned, whole life policies provide cash value guarantees that cannot be forfeited by the policy owner. The table of guaranteed values included in each policy shows the amount of cash value available to the policy owner at the end of any year the policy is in force. In this particular example, a whole life policy for $50,000 would accumulate $1,550 of cash or loan value by the end of the 5th year. After 10 years, the cash value would be $4,650. No matter what the mortality rates are for the same insuring class, or how well the insurance company's investments perform, the owner of this whole life policy is guaranteed cash values indicated in the table.
All right, so those are the guarantees that they have. Perfect. Go. Non-forfeiture options are triggered by policy surrendered or lapse. So cash, the policy owner simply surrenders the policy for the current cash value at the time when coverage is no longer needed or affordable. Upon receipt of the cash surrender value, if the cash value exceeds premiums paid, the excess is taxable as ordinary income. Once this option is selected, the insured is no longer covered. A policy that has been surrendered for its cash value cannot be reinstated. We saw that on the reinstatement portion of the chapter. A surrender charge is a fee charged for the insured when a life policy or annuity is surrendered for its cash value. So let's look at this.
Fran receives a $50,000 divorce settlement and decides to use the money to purchase a single premium life insurance policy. After a serious car accident 4 years later, she surrenders the policy for cash in order to have extra money to pay bills. Because she surrendered her policy early, she must now pay a surrender charge.
Mm.
Right? Yeah. It is a yes. Extended term is the automatic non-forfeiture option. Same face amount, shorter term of coverage. Okay. Reduced paid up insurance. Under this option, the policy cash value is used by the insurer as a single premium to purchase a completely paid up permanent policy that has a reduced face amount from that of the former policy. The new reduced policy builds its own cash value and it will remain in force until death or maturity. So basically kind of what happened here without the getting it out. So you have a reduced paid up insurance. Use the cash value of one to go and buy another policy that has less cash value. I mean, less face amount. Let's check this little table. Just extender 50,000 whole life non-forfeiture table for 20 years, which is always included. Cash or loan value reduced paid out. Let me read that one again. Under this option, the policy cash value is used by the insurer as a single premium to purchase a completely paid up permanent policy. Todavía, the new reduced policy. If the insurer chooses to exercise the reduced paid up option at the end of 15 years, the cash value of $8,100 can be used as a single premium to purchase paid up insurance of the same type as the original policy. The insurer doesn't have to pay any more premiums while still retaining some amount of the life insurance. In this example, $21,750. So this example over here, you use your cash value to purchase a reduced paid up policy of $21,000. Okay, now it's a little bit better. Dividends and dividend options. Dividends are paid only on participating policies, so not every policy will pay you dividends. When the policy owner purchases a policy from a participating insurer, he or she actually pays a grossed up premium. The higher premium is charged as a safety margin in the event the insurer loses. The insurer's losses are higher than anticipated. If this extra amount is not needed by the insurer to pay death claims and expenses, or if actual mortality experience improves or interest earned by the company exceeds the assumptions, a dividend will be returned to the policy owner. In other words, dividends are a return of excess premiums, and for that reason, they are not taxable to the policy owner. Insurance companies cannot guarantee dividends. Dividends, if only if they are showing basically profits on those policies, or they have excess of premiums. Trust me, companies will do everything they can to not show them, so they don't have to pay them. But when they're paid, they are not taxable, and the company also cannot guarantee you. So you might see policies that say, hey, we pay dividends. That does not mean every year you're going to receive dividends. So if there is excess of premiums, they will pay them, but they're not required to, but they're not guaranteeing they will pay them every year. The first dividend will be paid as early as the first policy anniversary, but must occur no later than the end of the third policy year. From then on, dividends are usually paid on an annual basis. Policy owners have the option of taking their dividends in one of several different ways. So know this, basically from all of that, dividends are a return of excess premiums, therefore not taxable when paid to the policy owner. Cash, the insurer simply sends the policy owner a check for the amount of the dividends. These are the ways the dividends are paid. So they're paid in cash. Basically, you got a check. Reduction of premium, the insurer uses the dividend to reduce the next year's premium. So you're telling them, hey, keep it. I'll just pay the difference for next year. Accumulation of interest, the insurance company keeps the dividend in an account where it's accumulating the interest, and the policy owner is allowed to withdraw the dividends at any time. The amount of interest is specified in the policy and compounds annually. Although the dividends themselves are not taxable, the interest on the dividends is taxable. So if you hear the same song singing in all the chapters, any interest earned will be taxed in anything. Dividends, again, non-taxable. And then the other one is paid up additions. The dividends are used to purchase a single premium policy in addition to the face amount of the permanent policy. So no new separate policies are issued. However, each of these small single premium payments will increase the death benefits of the original policy by whatever amount the dividend will buy. So you can use, let's say you got a dividend of, I don't know, $1,000 or $100. You can go back to your agent and kind of buy an increase of insurance in there. If the policy owner did not choose the dividend option, like how to get that money, the insurer will automatically use the paid up additions to increase the death benefit of the original policy by whatever that amount of dollars can buy. Let's see, let's watch this little video on the paid up addition.
Al owns a $100,000 whole life participating policy. A dividend is declared in the amount of $300. Al did not choose a dividend option, so the insurance company will automatically apply the paid up additions option. The company will use Al's $300 dividend and buy a paid up whole life policy. The face amount of that policy will depend on Al's attained age. When Al dies, his beneficiary will receive the face amount of his original policy plus the total of the face amount from his paid up additions.
Perfect. Let's go over the options again, in which you can receive the dividends.
This example will help you remember what triggers each category of options, and which options will be automatically implemented if the policy owner failed to select one of them. When the insurer's actual need for premium is lower than what's being paid into the policy, dividend options become available. If a policy lapses or is surrendered by the insured, non-forfeiture options can be exercised. Policy maturity, whether at death or endowment, triggers settlement options. If no other dividend option is chosen, the insurer will automatically use paid-up additions to increase the death benefit of the original policy by the amount the dividend will buy. In the non-forfeiture options category, extended term would be implemented automatically to purchase prepaid term insurance of the same face amount as the original policy. Finally, when it comes to settlement options, if no selection was made by the policy owner, the insurer will automatically make a lump sum cash payment to the beneficiary.
That was basically a summary of what we've seen. So now we have paid up option. Usually the insurer first accumulates the dividends and interest and then uses the accumulated dividends plus interest and the policy cash value to pay the policy up early. So let's see. Watch this.
Sophia has a whole life participating policy in the amount of $100,000. Monthly premiums in a policy are scheduled until age 100 or the date of the insured's death. Since it is a participating policy, dividends have been distributed to Sophia every year, so she has chosen the paid-up insurance option. Under this option, the insurance company has taken the policy dividends and applied them to the premiums on the policy so that it will be paid up sooner than age 100.
So we're using that money to put it back into the insurance and therefore have less debt until it is. Okay. So 1 year term option, the insurance company uses the dividend to purchase additional insurance in the form of 1 year term insurance. That increases the overall policy death benefit. Then we have settlement options are the methods used to pay the death benefit to a beneficiary upon the insurance death or to pay the endowment benefit if the insured lives to the endowment date. Policy owner may select settlement option at the time of policy application and may also change that option at any time during the life of the insured. Know this, the settlement options are triggered by the insured's death or at age 100. Then we go into the settlement options. It could be cash. It's also called lump sum. You get one payment of all the proceeds of the insurance. Payments of the principal face amount after the insurance death are not taxable as income. Then you have life income option, is also known as straight life. It provides the recipient with income that he or she cannot outlive. Installment payments are guaranteed for as long as the recipient lives. So it makes a calculation how much money you want per month, and it pays you for an X amount of years. However, if the beneficiary dies shortly after he or she begins receiving installments, the balance of the principal is forfeited to the insurance. So if you happen to die after a year or so after receiving those payments, unfortunately, all that money is lost. Under life income or straight life settlement option, the recipient cannot outlive the benefit payments. So under life income with period certain option, the recipient is provided with the best of both worlds in terms of a lifetime income and a guaranteed installment period. Not only are the payments guaranteed for the lifetime of the recipient, but there is also a specified period that is guaranteed. For example, a life income with 10 years certain option will provide the recipient with an income for as long as he or she lives. If the recipient dies shortly after starting to receive the payments will be continued to a beneficiary for the remainder of the 10-year period. The life income joint and survivor option guarantees an income for 2 or more recipients for as long as they live. Most contracts provide that the surviving recipient will receive a reduced payment after after the first recipient dies. Interest only. So with this option, the insurance company retains the policy proceeds and pays interest on the proceeds to the recipient beneficiary at regular intervals. It could be monthly, quarterly, semi-annually, or annually. The insurer usually guarantees a certain rate of interest and will often pay interest in excess of the guarantee rate. The interest option is considered to be a temporary option since the proceeds are retained by the insurance until some later point when the proceeds are paid out in a lump sum or paid under one of the other settlement options. So interest only can only be for a limited amount of time that you're getting the interest, but then eventually they're gonna pay you, you're gonna have to pay another kind of, pick another kind of settlement option for it. Fixed period, under the fixed period installment option, also called period certain, a specified period of years is selected and equal installments are paid to the recipient. The payments will continue for the specified period and even if the recipient dies before the end of that period. So in the life income option, you're choosing your payments per month to the beneficiary, but if that person dies, then all that money is forfeited. Like you don't get anything. Under the fixed period, now, however, if you die, you also chose a beneficiary that will keep receiving the payments for the amount that you chose, for the period that you chose. And the fixed amount option is basically same as a fixed period. Now you're choosing a certain amount of money that you would like to get paid. If the beneficiary dies before the proceeds are exhausted, installments will continue to be paid to a contingent beneficiary until all proceeds have been paid out. Needless to say, always choose either fixed period or fixed amount, or better yet, get the cash and get with the financial agent and invest in something else. Keep that money moving, right? Okay, so now we're going to our chapter basically recap. Let's first recap the option types that we have. We have the non-forfeiture options, and then the available options under that one is reduced paid up, extended term, or cash. Extended term is the automatic. So non-forfeiture options, it's basically what you will do with those dividends if they're paying out. So you can say, hey, reduce paid up, meaning pay my premium, so next year I pay less. Extended term is basically it's extending or increasing your benefits, and then cash, basically you get a check for them. Now dividend options, you have the cash reduction of premium, like how do you want those to be paid, right? In cash, reduce my premium, accumulation of interest, paid up additions, paid up insurance, or 1-year term, which is, I think, what I just explained, non-forfeiture options. Let's go back up to those, because cash reduce paid up. Okay. non-forfeiture options are the minimum amount that you're guaranteed to receive from your money. Yes, sorry, okay. Back here. Settlement options, your cash, life income, interest only, fixed period, or fixed amount. So settlement options is how you're going to receive choices available to the insured owner for distribution of insurance proceeds, either to the insured or the insured's beneficiary, instead of an immediate cash lump sum. So cash is that lump sum payment, which is automatic. Life income, again, if you happen to die, you lose all the money. Interest only, for a certain period of time, you get only the interest that it keeps building up, and then any other form of settlement. You get fixed period, you want to get money or get paid for the 10 years, 5 years, whatever amount you choose of years. And then fixed amount, it's X amount of money, and you'll keep getting paid until the money is exhausted. In the last two options, if anything happens to you, the payments will continue to a contingent beneficiary. Now, chapter recap. We've learned a lot on this chapter. We have the standard provisions of the policies, which these are all required by state law that must be on the insurance policy. We have consideration, which is the binding force of any contract. I pay you my premium and I have benefit at the end of it. The entire contract, which is the policy with writers and amendments and a copy of application. The grace period, the time period after the premium is due, during the which the policy will not lapse. Incontestability, an insurer cannot contest misstatements on the application after a time period. Do you guys remember how long is that? What's the time for what's the incontestability period? Or how long?
Is that the 14 days?
No,
Yeah,
it's 2 years, like Ellie said. The 14 days is the
Oh,
free
okay.
look provision.
I'm saying 3.
Okay.
Yeah, it's the free look provision. 3 years, it's the reinstatement clause.
Okay,
All right,
gotcha.
good. There go. All numbers were there. Yes. The insurance clause is a basic agreement between the insurer and the policy owner. Misstatement of age or gender, death benefit is adjusted according to the correct age and gender of the policy issue. Payment of premiums, premiums are paid in advance. Reinstatement, a policy can be restored within a specified period of time with proof of insurability, that is normally 3 years. Other provisions, assignments, they can be absolute or collateral. That's when you transfer the ownership rights of the policy. Exclusion, that's what will happen for the policy not to pay. Aviation, non-commercial, again, hazardous occupation, war or military service, and suicide within a specified period. The specified period for suicide is 2 years as well. Okay, or even commit a felony. You may find that question as well. If you go and commit felony and you get killed while committing a felony, it's also 2 years. The free look provision, policy can be returned for a refund of premium within a specified period of time. Now we're all from Florida, so that free look is 14 days here in Florida. The ownership is the policy owner's rights. Now, beneficiaries, we have designations, which is individuals, including minors, classes, and states. Succession, which is the levels of priority. Each level in the succession is only eligible if the beneficiary in the level above has died. So remember that question that had the succession, se me traba la lengua. Succession? Okay. So it will pay in that order, and it will only pay the second or third if the first and second have passed away. So primary, first claim to the policy proceeds, contingent, secondary, or what she said, next claim after the primary, tertiary. Okay, I think I got it.
We can't hear her.
Yeah, I know. I'm gonna have to buy like microphones, man. Okay, policy owners is the right to change a beneficiary, and we have two. Remember, revocable and irrevocable. So the revocable can be changed at any time. Irrevocable can only be changed with the beneficiary's consent. If it's easier, think about spouses and how weird it will be to have your spouse as an irrevocable beneficiary, and after a divorce, you need his signature or her signature to authorize you to change the beneficiary on your own policy. Right? So I think with that in mind, it's easier to remember those. Common disaster clause protects the rights of contingent beneficiaries if the insured and the primary beneficiary died at approximately the same time. It is assumed that the primary beneficiary died first. The common disaster clause, you can also remember it because mostly protects the contingent, and basically protects you as a policy owner, right? So like your wishes be true, like if the beneficiary, you and the primary died within a few days of each other, that your policy will not be forfeited, it will go to your contingent. Policy loans, withdrawals, and partial surrenders. So cash loans available, policies cash value minus any unpaid loans and interest. Automatic premium loans prevents unintentionally policy lapse due to non-payment of premium. So automatic premium loans, think about it's like auto pays from your savings account on that cash value policy to your insurance portion of it. Now we go into the rider section. Disability, it's that waiver of premium, waives the premium if the insured becomes totally disabled, 6-month waiting period before the benefit begins. So on month 7, they start paying. Waiver of monthly deduction waives the cost of the insurance in the event of the insurance disability. So waiver of premium, you'll find it mainly in the term life insurances. Waiver of monthly deductions, you'll find them in the policies that have cash value, because those are the ones that have monthly fees as well, to maintain the other ones. Payer benefit functions like a waiver of premium rider, and is used for the juvenile policies, so like to protect the kids' policies. Accelerated benefit, it's early payment if insured is diagnosed with specified catastrophic illness. A portion of the death benefit, the death benefit is reduced by the amount paid plus earnings lost. Additional insured, you have the spouse or other insured, which are always term riders. So the additional insureds are always term. It's limited time and limited coverage, and usually expires when your spouse turns 65. You have the children's terms, which covers all children of the insured. Again, limited time, limited coverage, and can be converted to a permanent policy. And then you have the non-family insured, which is used by businesses for the key person insurance and things like that. Now you have riders that affect the death benefit, which is the accidental death, which pays double or triple if the accident of death occurs as defined in the policy, and death must occur within 90 days of the accident. Guaranteed insurability allows for purchase of additional insurance at specified times without evidence of insurability at the insurance attained age. And return of premium, increasing term is added to a whole life policy that provides that if death occurs prior to a given age, not only is the death benefit payable to the beneficiary, but all premiums paid as well. Then we go to the options. Non-forfeiture, reduced paid up insurance uses cash value as a single premium to purchase a permanent policy with a reduced face amount. We also have the extended term. Automatic option uses cash value to convert to term insurance, and cash surrender value. After that, there is no more insurance. So after you surrender your policy, that's it. Once you get that cash, you're no longer insured. Dividends. You have the options of cash. So the insurance company sends you a check. Reduction of premium. The dividend is applied to the next year premium. Accumulation of interest, you can put that dividend or tell them to automatically do it to an account that accumulates interest. Paid up addition, dividend is used to increase the face amount. Paid up insurance, the dividend is used to pay up the policy early. In 1-year term, dividend is used to buy additional insurance. Settlement, you can get your settlements into this couple of options. You have cash, which is one lump sum, usually not taxable. You have life income, provides an income to the beneficiary, cannot outlive. So no guarantee that the entire principal will be paid out. If the beneficiary dies too soon, available, so If the beneficiary dies too soon, the money is lost and is available as a single life or joint and survivor as well. Interest only, insurer retains the principal and only pays out the interest. Fixed period, payments for a specific time period until all proceeds are paid out, or fixed amount, payments in specified amounts until all proceeds are paid out as well. So let's look at this quick video and we go to the quiz.
This chapter covered a lot of information.
Yes, it did.
I bet your understanding of life insurance is becoming more and more clear. How about a pop quiz? What constitutes the entire contract?
What do you guys think?
So the
that's-
whole contract, so the application, the policy.
Premium and the policy writers or amendments. I think that was it. That's it.
The insurance policy with a copy of the application and any riders and amendments.
Writers.
Which rider allows an insured to purchase additional coverage without evidence of insurability?
Which writer allows?
Without-
The renewable.
It's
Oh wait, additional coverage with the which writer?
yep, it's a writer.
Which writer allows insurance?
What do you think?
I
The
don't know.
guaranteed insurability. That's the one, guaranteed insurability.
Guaranteed insurability rider.
I gotta write that.
What are the 3 non-forfeiture options?
What's the cash? Paid up?
Cash surrender value, extended term, and reduced paid-up insurance. Did your answers match up? Before moving on, check the learning objectives established at the start of the chapter. Identify and describe common life policy provisions. Know the different types of beneficiary designations. Explain the 3 non-forfeiture options. Describe dividend options and know what types of policies offer them. Identify the various settlement options and know why each may be selected. If you feel like you need a refresher, look over the chapter again and review the points.
Let's go to quiz. Quiz time. So question 1, which non-forfeiture option has the highest amount of insurance protection? A, decrease in term, B, reduced paid up, C, extended term, or D, conversion?
Decreasing term.
Okay, so let's do one thing first. Non-forfeiture option had 3 options within it, right? And should just cover
Yeah.
them. I don't think decreasing term or yes, decreasing and extended were not there. So we have reduced paid up or conversion. And I think which non-forfeiture option has the highest amount of insurance protection? I think it's what you said, reduced, but yeah, reduced paid up. What do you think? Should we try it?
Mhm.
See what-
Yes.
That was one of them. Conversion is the one that was not. The extended term non-forfeiture option has the same face amount as the original policy, but for a shorter period of time. Wait, non-forfeiture option has the same face amount as the original policy, but for a shorter period of time. Okay, so the 3 options for non-forfeiture is the reduced paid up, the extended term, and the cash. All right, let's go to the next question. That was one. I don't have anything. What is the term of how frequently a policy owner is required to pay policy premium? Is it A, mode, B, schedule, C, grace period, or D, consideration? So let's read the question again. What is the term for how frequently a policy owner is required to pay the policy premium? Ellie says mode. No, grace period is a period they give you. So let's eliminate. Grace period is a period they give you from your due date to the time it's gonna lapse. So around 30 days, right? Consideration is what's binding in a contract. I give you payment for a benefit, right? So schedule is just whenever you're scheduled to pay, but mode is a term of how frequently you can pay the policy. Yes.
Oh, the premium mode.
Yeah, the premium mode. Question 3, a policy owner who is also the insured wants to name her husband as the beneficiary of her life policy. She also wishes to retain all of the rights of ownership. The policy owner should have her husband named as the A, secondary beneficiary, B, contingent beneficiary, C, irrevocable beneficiary, or D, revocable beneficiary.
D, revocable.
Okay, perfect. And the two that you can automatically kind of like secondary and contingent. Good job. Question 4. An insurance misstates her age at the time the life insurance application is taken. The misstatement may result in A, adjustment in the amount of death benefit, B, no change whatsoever, C, automatic lapse, D, recession of the policy. Ellie says A.
Me
I
too.
said it too.
Perfect. Question 5. The dividend option in which the policy owner uses dividends to purchase a term policy for 1 year is referred to as A, 1-year term option, B, paid up option, C, accelerated endowment, D, paid up additions. Ellie says A. Dividend option which policy. Good job. Question 6. If the policy owner, the insured, and the beneficiary under a life insurance policy are 3 different people, who has ownership rights? A, policy owner, B, the insured and the policy owner, C, beneficiary, D, the insured.
The policy.
Ellie says the same, policy owner. It's that term money talks. Okay, policy owner pays. The interest earned on policy dividends is A, 40% taxable, similar to capital gain, B, taxable, C, non-taxable, D, tax deductible.
And it's C, non-taxable?
And
No, the interest, they're always taxable.
yes, so the dividend is non-taxable, but any interest earned on it, it's taxable. 8, when a whole life policy lapses or is surrendered prior to maturity, the cash value can be used to A, pay back all premiums owed plus interest, B, receive payments for a fixed amount, C, purchase a single premium policy for a reduced face amount, D, purchase a term rider to attach to the policy. So when a whole life policy lapses or is surrendered prior to maturity, the cash value can be used to. So surrender means you no longer have the policy. So automatically in my head, I can add a term rider that attached to that policy. Ellie says C. You can purchase a single premium policy for a reduced face amount. So take all the
Yes.
money that they're giving you to buy another policy.
Yep.
I think C.
Perfect. Yes, ladies. What type of insurance will be used for a return of premium rider? A, decrease in term, B, annual renewable term, C, increase in term, or D, level term. So what type of
Oh, go ahead. Sorry.
what type of insurance will be used for a return of premium rider? And we saw these ones on the review questions.
Yeah, you just did, yeah.
What do you think?
I think I'm between B and C, to be honest.
So let's think about what type of insurance will be used for return of premium rider. Yes, that means return of premium rider. It's a rider that you add to your policy that says that if you die within a certain amount of years, not only do they pay the death benefit, but they also pay every single premium you've paid in. So that's C. Yeah, it's increase in term.
Okay.
So since you buy it for an X amount of years, it's increasing the amount. So the return of premium rider is achieved by using increase in term insurance. When added to a whole life policy, it provides that at death prior to a given age, not only its original face amount is payable, but also all premiums previously paid are payable to the beneficiary. So it's increase in term. So think return of premium rider, it's always increasing. Just think about being expensive. Question 10. All of the followings are true regarding the guaranteed insurability rider except A, the insured may purchase additional insurance up to the amount specified in the base policy. B, it allows the insured to purchase additional amounts of insurance without proving insurability only at specified dates or events. C, this rider is available to all insureds with no additional premium. D, the insured may purchase additional coverage at the attained age. All of the following are true regarding the guaranteed insurability rider except. So we're looking for the wrong answer. What is not guaranteed insurability? So let's see. It allows the insured may purchase additional insurance up to the amount specified in the base policy. I don't know. I'm trying to look for the ones that we can completely take out. So B, it allows the insured to purchase additional amounts of insurance without proving insurability only at specified dates or events. So you don't prove insurability, I think, if you're married or if you're having kids, right? That was the provisions under that insurability. C, the rider is available to all insureds with no additional premium. Ooh. I think it's C, because if you're increasing things, you have to pay more premium. And then D, the insured may purchase additional coverage at the attained age. That is right, you purchase at the attained age. Do you guys want to try C, or do you have another option that you think more strongly about? You think it's C? Hey, look at you, yes. Yes, if you're buying more insurance, they're always going to charge you more. There's no other way around it. Question 11. Which of the following information will be stated in the consideration clause of a life insurance policy? A, the time period allowed for the payment of the premium. B, the conditions of insurability. C, the amount of premium payment. D, the parties to the contract. So which of the following information will be stated in the consideration clause of a life insurance policy? So let's think back to consideration clause. The consideration clause says, I pay you X amount of money per month, or the mode of premium that I chose, and then you give me a death benefit in the event of a loss. Ellie says it's C, the amount of premium payment.
Yes.
You guys are killing it. Question 12. Which of the following settlement option in life insurance is known as straight life? A, life with period certain. B, fixed amount. C, life income. D, single life.
Single life.
Ellie says single life.
Yeah, single life.
Single life? I think it's life income. Let's see if you guys are right. Life
Life
income. Oh, it's on the wall over there, baby, in the game room. So life income option, also known as straight life. By the way, I clicked what you guys thought, and even though I said it before, I clicked it because we've only had one wrong. So we were gonna pass it. We were like in the borderline of not passing it. But the life income option, also known as straight life, provides the recipient with an income that he or she cannot outlive. So life income and straight life, it's the same thing. Single life, I don't think I've heard the term. I've heard single premium, right? You've heard? Maybe. It's just maybe it's confusing, like the terms. But life income, think of life income as straight life. Next question, 13. When the insured selects the extended term non-forfeiture option, the cash value will be used to purchase term insurance with what face amount? A, in lesser amounts for the remaining policy term of age 100. B, equal to the cash value surrendered from the policy. C, the same as the original policy minus the cash value. D, equal to the original policy for as long as the cash value will purchase.
Okay, when
So when the insured selects the extended term non-forfeiture option, the cash value will be used to purchase term insurance with what face amount?
with the same, no, equal
With
to
what?
the
Equal to
original.
the rather
So D,
equal to the for as long as the cash value. That's an option. You guys want to try that? What do you think? So we know it's not A. Policy term of age 100. There is no term insurance that will be. It says remaining policy term equal to cash value surrendered from policy. So I will feel 100% more confident if it will say for what like reduced face value. You know, so let's kind of think of what will that mean, because it says the cash value will be used to purchase term insurance with what face amount? The same as the original policy minus the cash value, equal to the original policy for as long as the cash value will purchase. So you want to try D? Tati, I think you said it, right?
yeah.
Let's try D. So the first part for me is confusing because it says equal to the original policy. I cannot buy something equal to original policy if I'm buying it with the cash value of it, right? But then it says for as long as the cash value will purchase it. And so that whole sentence is, hey, yes, I want something equal to the original policy, but as long as whatever cash I'm giving you, I will buy it. Is that on the wall? Okay, a second. An insured, question 14, an insured has chosen joint and 2/3 survivor as a settlement option. What does this mean to the beneficiaries? One of the beneficiaries will receive 1/3 and the other 2/3 of the proceeds when the insured dies. B, the surviving beneficiary will continue receiving 2/3 of the benefit paid when both beneficiaries were alive. C, the beneficiary will receive 2/3 of the lump sum upfront and the remaining 1/3 will be paid over time. D, the beneficiary will receive 2/3 of the total benefit with the final 1/3 payable when the first beneficiary dies. What do you guys think?
I'm not sure, but I'm gonna go with B.
It says an insurer has chosen joint.
Not sure.
Which one do you guys want to try? Okay, so let's see. An insurer has chosen a joint and 2/3 survivor as a settlement option. What does this mean to the beneficiaries? One of the beneficiaries will receive 1/3 and the other 2/3. The surviving beneficiary will continue receiving 2/3 of the benefit paid when both beneficiaries were alive. Who said B?
Me.
Tati? Wanna try B?
Yeah.
So joint.
I mean, whatever you might
No.
think.
Isn't joint when they paid after both die, so there's no surviving. But I can try whichever you guys want. So the surviving.
I think it's C.
The joint, please. Mildred thinks it's C. The beneficiary will receive 2/3 of the lump sum upfront. The remaining. Okay. I'd say let's go with Mildred's option. It was Tati's option. Look at that.
Sorry, Tati.
Tati's like, I told you Why you doubting me? So when the reduced option is written as joint and 2/3 survivor, the surviving beneficiary receives 2/3 of what was received when both beneficiaries were alive.
But it's just, she's gonna still receive the same amount, only 2/3 of it.
Yes. So if they're asking you for the joint and 2/3 survivor as then the surviving beneficiary. I think that should have given that should have been a given for me when my brain was tired. Okay, let's go to the next one. All of the following are true regarding insurance policy loans, except we're looking for the wrong answer.
Okay.
A, the policy will terminate if the loan plus interest equals or exceeds the cash value of the policy. B, policy owners can borrow up to the full amount of their whole life policy's cash value. B, C, policy loans can be made on policies that do not accumulate cash value. D, the amount of the outstanding loan and interest will be deducted from the policy proceeds when the insured dies. Right, I think it's a given. So you're looking for the wrong answer, right? So what do we know about the policy loans on the cash value? If your loan is greater than the cash value that you have, then it will kind of terminate that policy because then kind of you owe more than what you have. You can borrow up to the full amount that you have in there. And if something happens to you when you still have loans, the death benefit will be reduced by the loans and interest from it. And we also know you cannot borrow any money from a policy that does not have any cash value in it. Right? So policy loans can be made on policies that do not accumulate cash value. No, you can't. Another one. Okay, so how do you guys feel about chapter 3?
I feel good. I just need to go over certain definitions, and I think I will be good.
Yes.
I understood basically everything, but I'm still confused in 2 or 3. So I need to work on the definition.
So what I would recommend is try to take some time tomorrow and go through the chapter, but like what we were doing, like the review questions, and then scroll a little bit and go review questions and scroll a little bit and go review questions. That way you can review the chapter itself. So tomorrow, I think before going into chapter 4, which is another big chapter, we'll do a quiz on chapter 1, a quiz on chapter 2, and a quiz on chapter 3. Because what I don't want to happen is that we get to chapter 5 and we forget chapter 1. So since I don't want that to happen to us, I want to do 1 quiz each, which should be okay. And then we maybe start chapter 4, depending on the time that the quizzes took. I think we should have enough time to at least do half and do like the review questions. And then the day after tomorrow, we can finish the chapter and then do the full quiz on it. Okay?
Isn't it Tuesday at Miguel's? Are we going to be able to do this?
We'll see. So let's do a review tomorrow, and then we'll play it by ear on Tuesday.
Okay.
And see if we can study. Maybe we'll just stay a little bit longer and study the start the chapter or finish the chapter.
Okay.
Okay. Perfect, ladies. Thank you. See you tomorrow.
Thank you. See you tomorrow.
Yeah. Bye-bye.
Bye.